Welcome to Money and Good Sense. In this video, we're going to talk about stocks. Almost everyone has heard of them. But what exactly is a stock? What are you actually buying when you purchase a stock? Do you really become part owner of a company? How do investors make money from stocks? Why do some stocks increase in value for years while others decline? And why do some companies pay dividends every year while others don't? After watching this video, you will understand what a stock is, how you can make money from investing in stocks, and what risks are involved. That way, you have solid information for understanding of future videos about investing and the stock market. Let's get started. What is a stock? A stock represents a small ownership interest in a company. When a company wants to raise money to grow, it can choose to issue shares of stock. Anyone who buys those shares becomes a part owner of the company. That doesn't mean you suddenly become the boss. You simply own a small portion of the entire company. The more shares you own, the larger your ownership stake becomes. For example, suppose a company has issued 1,000 shares. If you buy one share, you owe 0.1% of the company. If you buy 10 shares, you own 1% of the company. If you buy 100 shares, you own 10% of the company. In theory, you could even buy every share. If you did, you would own the entire company. In practice, that's almost impossible with large publicly traded companies because they often have millions or even billions of shares outstanding. The most important thing to remember is that a stock is simply a small ownership interest in a company. Why do stock prices go up and down? When you buy a stock, its price is not fixed forever. The value of a stock can change every day. Sometimes the price goes up. Sometimes it goes down. But why does that happen? If a company grows and becomes more profitable, many investors see that as a positive sign. More people want to own part of that company. As a result, demand for the stock increases. When more people want to buy a stock than sell it, the stock price usually rises. On the other hand, if a company performs poorly, for example because its profits decline or its future outlook becomes less favorable, some investors may decide to sell their shares. As a result, the supply of shares increases. When more people want to sell a stock than buy it, the stock price falls usually. The price of a stock is not determined directly by the company itself. Instead, it is constantly determined by supply and demand in the stock market. You can compare it to a house. When many people want to buy the same house, the price usually goes up. If there are only a few buyers, the price will often go down. Stocks work in exactly the same way. The greater the demand for a stock, the higher its price will usually be. The greater the supply, the lower its price will usually be. Over the long term, stock prices often reflect a company's performance. In the short term, however, prices can also rise or fall because of expectations, news, or investor emotions. Dividends. Not every company rewards its shareholders in the same way. Some companies distribute part of their profits to their shareholders. This payment is called dividend. If you receive a dividend, you are paid an amount of money as a shareholder. How much you receive depends on the number of shares you own. Not every company pays dividends. Some companies choose to reinvest all of their profits back into the business. They may use that money to build new factories, develop new products, or continue expanding. As a result, these companies pay little or no dividend. That does not mean they are worse companies. They simply choose to invest their profits today to support future growth. Other companies grow more slowly and instead distribute a larger portion of their profits to shareholders. Neither approach is necessarily better. It depends on the company's strategy and on what you, as an investor, consider most important. Some investors prefer receiving regular dividend payments as additional income. Others prefer companies that continue investing in their growth, hoping the value of the stock will increase more over time. Both strategies can be successful. What are the risks? Investing in stocks can provide attractive returns. However, there are also risks involved. The value of a stock can go up, but it can also go down. If a company performs poorly, the price of its stock may decline. If you sell your shares at that time, you could lose money. In some cases, a company may lose money for years. As a result, more and more investors may lose confidence and decide to sell their shares. This can cause the stock price to fall even further. In the worst case scenario, a company may even go bankrupt. If that happens, shareholders can lose a large part or even all of their investment. That is why it is important to understand that investing is never without risk. On the other hand, investors accept that additional risk because they hope to earn higher returns than they would from, for example, a savings account. In a future video, we'll explain how investors can reduce risk by diversifying their investments. Conclusion. You now understand what a stock really is. A stock is simply a small ownership interest in a company. The more shares you own, the larger your ownership stake becomes. The value of a stock can go up, but it can also go down. Its price is constantly determined by supply and demand in the stock market. Some companies also distribute part of their profits to shareholders. This is called dividend. Other companies choose to reinvest those profits to continue growing. Neither approach is necessarily better. Investing in stocks can provide attractive long-term returns. However, those potential returns come with risk. A stock can lose value, and in the worst-case scenario, a company can even go bankrupt. That is why it is important to always understand what you are investing in. In future videos, we'll take a closer look at topics such as the stock market, stock prices, dividends, company valuations, investment risks, and diversification. Step by step, you'll gain a better understanding of how investing really works. For now, I thank you for watching. And as always, don't worry too much. Everything can be overcome with study and patience.